Hello, everybody, and welcome. My name is Bennett Tchaikovsky, also known as the Accounting Professor. And today we're going to be looking at our first series of videos about external financial reporting with the Securities and Exchange Commission. My disclaimer and copyright notice: the information and opinions in this presentation are those of the author only and not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2025 by Bennett Tchaikovsky, all rights are reserved. Any distribution is strictly prohibited. Note that this presentation will refer to companies and other third parties. Note that I do not claim any copyright that belongs to those third parties. Okay, so maybe the good way to kind of go through before going through the forms is let's go to sec.gov, right? So this is not the Southeastern Conference. Rather, what this is the Securities and Exchange Commission. So if you are a publicly traded company, you are required to make filings here because you are selling your shares to the public, right? So if I look over here, right? So Alphabet right now is selling for $193 per share. So if I come over here to search filings and I look up over here, basically Alphabet Inc. or Google, what I will find are a lot of different reports. And we're going to go through all of these different reports here. But again, this is for external financial reporting, meaning that what are companies required to go through and file once they have their stock trading on an exchange. And it could be the over-the-counter OTC markets. It could be the NASDAQ. It could be the New York Stock Exchange. And there's different tiers within each of those. But just to kind of go through and give you a general overview, is that every year a publicly traded company, and again, there's always going to be exceptions like Alibaba, there are going to be other like foreign companies that file what they call thing at 20, like they're foreign filers. I'm not dealing with those in this video. I'm focusing on US listed companies. So let's go through these. There's first the Form 10K. This is an annual report, meaning it's going to contain audited, right? Very, very important. Audited, not reviewed, but audited. It's audited by an accounting firm that has to be registered with the PCAOB. What is the PCAOB? Well, the PCAOB, see what happens if I got it right. Oh, great. I got it. If I type in something else like gov, I get like knocked out. But this is basically where you can find out from investors if I want to find out who is the auditor of a particular company. If I type in here Meta platforms, I'm going to find out who is the auditor. It is Ernst and Young. And here is the engagement partner. And as you can see, they just rotated their partners. So again, when we look at the 10K, this has to be basically you have to have it be has to be audited by an accounting firm that has to be registered with the PCAOB. If you are thinking about doing this as a smaller accounting firm, don't do it. Stay with bookkeeping and tax. You'll be much happier, but I'm covering this for my class, so here you go. This is filed once per year. A lot of other requirements with it, but this is the Form 10K. The Form 10Q. This is a quarterly report. It has to be reviewed. It's not an audit, it's a different scope. But this is filed every 3 months or quarterly 3 times. So you're going to have one 10K and three 10Qs. If we come back over here to Google or Alphabet, you're going to say, oh, 10K September 30th. To be 10Q September 30th, 10Q June 30th. 10Q March 31st and a 10Q December 31st. So we kind of see this part over here in terms of, what that goes through and looks like. Next one over here is we have a Form 8K, and I'm going to go into this a lot more in depth, but the 8K, and one of the things I want you to think about is when we do public reporting, one of the things we have to worry about is that if myself as a CFO or as a CEO, if I talk with one investor about information that is non-public and that information could be used by that investor or anybody else to trade in the stock, that is something called insider information. And we do not want to be engaged in doing that. So when a company has things that are happening outside of the release of its numbers, we use what we call a Form 8K. And if you look at this here in this series of slides that I've developed for this part, oh, Form 8K, oh, current report, oh, financial information, oh, look at this. That's a lot of stuff. So we're going to be going through that in depth. But I wanted just to kind of make sure for you that you kind of know what these forms that we're going to be going through and covering are. Then we have definitive proxy statements. Well, we have shareholders. Who are the shareholders' representative? They are the board of directors. Board of directors are elected by the shareholders. The board of directors basically then represents those shareholders, and basically these definitive proxy statements are used for that purpose. We also have Form S1 and S3. If a company wants to raise money, they have to file special reports with the Securities and Exchange Commission to register securities to sell. That's how the shares go from the company's treasury into the public. Then we have Forms 4, 3, and 5, which disclose different ownership interests. And I'm going to go through with all these different ones. I'm going to be going through and sending you examples. Now, in terms of, and this is actually on the CPA exam, in terms of looking at the status of companies, in terms of when they have to go through and file, this becomes extremely important. If somebody is a smaller reporting company, they have to go through and obviously, and it's defined by a public float of less than 75 million. What does that mean? Well, it basically means a public float is referring to shares that are not owned by company insiders. If I took those shares and I took the market price of the stock on a certain day of the year, forgive me for not knowing this at the very beginning, that will determine whether or not your company is either a large an accelerated filer, or a smaller reporting company. This comes into really great amount of importance when it comes to certifying and testing internal control systems. If I am a smaller reporting company, I have to have internal controls for my business, meaning that I have to have internal checks and balances, but I may not necessarily have to have them tested separately from the regular audit. Whereas if I am a large accelerated filer, Alphabet, Meta Platforms, Home Depot, I will be going through and required to have those attested to. It is very expensive to have that attestation done. So if I am going through and I am essentially, when do I have to file stuff? With an 8K, and I'll show you those different ones, it's generally within 4 business days. However, here, if I'm an accelerated filer, I have to file my quarterly report within 40 days, my annual report within 60 days. If I'm non-accelerated, I have a few more days over here for the Q and then for the K. What you're going to notice is, oh, for Alphabet, their quarter end was September 30th. They filed it on October 30th. Here, their quarter end was June 30th. They filed it on July 24th. Here, their quarter end was March 31st, so they are in a larger accelerated filer. So coming over here, you've got this in terms of when this is going through and being filed. And just give me a moment. So here is a microcap stock. I just found this by going through and looking at microcap cap stock. So when we look at First Western Financial and we look at their annual report, we know that they are a smaller, non-accelerated filer because they're going through and filing by March 15th, meaning that they could file up until March 30th. Over here, they're filing there for March 31st. They're basically filing, it was actually, they're doing pretty good on this part. So again, in terms of their filing part. So again, those are examples in terms of when you're going through and looking at whether someone is an accelerated or a non-accelerated filer. This is the important thing I want you to kind of take away from all of this is by when you do decide to become a publicly traded company, everything is open to the public generally. You want to avoid selective disclosure. And what I mean by that is what I was kind of referring to before. If I tell something to one investor, I need to make sure I'm sharing it with everybody. When I was working as a chief financial officer in my former life, I had to make sure that when I was talking with investors, that I was staying within the public filings. You have to stay within those filings to talk about the operations. Now, also, when I would present at conferences, I would make sure that our attorneys had filed a PowerPoint for me to kind of go through and to walk through it, but I would make sure that that PowerPoint was public because if it's public, then everybody can go through and look on it. And the real thing is you want to stay compliant with Reg FD, which is full and fair disclosure, meaning that all investors are basically on a similar wavelength. That's one of the main goals, or one of the several different goals in external financial reporting for publicly traded companies is to avoid selective disclosure. We do not want to be engaged in that, and it's incredibly important for us to basically ensure that when we are in fact disclosing information, it is being disclosed to everyone. I want to thank you today for watching. Please remember to like and subscribe. I look forward to seeing you on future videos, and I'll see you soon. Have a great day.